I just got back from our Orlando summit. It was a blast. It was a lot of fun to meet clients again, and we had a lot of great discussions, went over all sorts of situations about the market in terms of what might be the path of least resistance going forward. And I do look forward to welcoming anyone that's listening here to our next one that we will announce in the not too distant future. It's always fun to meet people in person. Hey, everybody. This is our new episode of the Steady Wealth Podcast. And what I'd like to talk about today, right now, is actually very near term or very up to date. And it's just very simply, are markets oversold? And when we talk about markets here, I do want to specifically talk about equities and potentially and look at whether there may be an opportunity to get some sort of a bounce here. This is one of the things that we discussed in pretty great detail. In fact, I would say very great detail in Orlando over the past 2.5 days, last Friday to Sunday. And I will give you just a little bit of an idea of kind of some of the things that we were looking at. So let me recap something that we talked about, I think, in the last podcast episode or the one before, which is the potential for a year-end rally. And I want to reiterate what I said in that podcast episode, which is very simply that I think the odds of a traditional year-end rally are lower this time around. And that really has a lot to do with where we are in terms of the economic cycle, but also things like taxation, basically tax loss harvesting. There is a smaller chance than usual that people will wait to sell stocks until the new year because there's really plenty of stocks that have losses that they could offset gains with. So one could have a wash in the sense of selling something that's down and selling something that's up and kind of offset the taxes, so one does not have to wait until next year. It's actually quite rare to see stocks up as much as they are year to date, but having in terms of the indices, I should say, but really not many stocks are actually up. In fact, most of them are down for the year, and bonds, of course, are totally down for the year. Let us talk about what is going on currently. We have a big week ahead, by the way. Again, this is very near-term focus today, but if I look at the economic calendar, and I will share my screen here, or for those people that want to see some charts, I will describe them as usual, so you don't have to be able to see the screen at all. It'll be just fine without seeing the chart. But we do have a pretty big week. First of all, it's the end of the month, obviously on Tuesday, October 31st, depending on when you listen to this. Maybe it's already past the 31st. It'll be Halloween. And then we start Wednesday into a new month. That is the month of November. That gives us 2 months left in terms of the year. We are going to have a whole bunch of data. We're going to hear from the Fed. There is a Fed meeting. We will get that data Wednesday afternoon on the 1st. And then we have jobs data on Friday. So it's a busy week, or a big week, I should say, once again, for economic data. So we want to be aware of that. On top of that, we'll have more earnings. A lot of earnings are still coming out. Keep that in mind. But one of the things that we talked about in Orlando at the annual summit is the near-term conditions here for equities are looking increasingly oversold. And I would like to show you a few things here that we're seeing that's, I think, pretty compelling in terms of a potential bounce. But I also want to reiterate that we still do see a much lower probability than usual for a lasting year-end rally. So we may see a bounce here, but I do have my doubts that we'll see a lasting rally in the year-end. Of course, we would love to see that, and if it happens, we will look to participate. But for right now, we're more looking at this as potential of a near-term bounce. And so let me go through that a little bit and give you some names as well that we're looking at very specifically. So this should be something that's quite to the point as usual. One of the things that I would like to share with you first, before we even look at the near-term oversold conditions, is I would like to share with you what we are seeing right now in terms of, and let me try to find the right chart here. Give me just 1 second. What we are seeing here right now in terms of the broader market. So I'm going to show you a chart here, and I will also share this out on social media. And if you didn't know what this is, so if you can somehow hold off here and not look at the ticker at the upper left-hand corner, I would imagine that some of you, maybe many of you, would view this as a bullish pattern. And I indeed would agree. This is a bullish pattern. We've got a double bottom. We've got moving averages. We just broke above that 200-day moving average. That's the red line. We broke above this trend line. It's a overall bullish looking chart. What this actually is the inverse chart of the S&P 500. So this is actually a very bearish chart in terms of what it represents for equities, because it's the inverse of the S&P, meaning this breakout here that we saw or seeing here, witnessing, is actually a breakdown in stocks on the S&P 500. Maybe we're a bit overdone here, so let's see if we could make a case for potentially some mean reversion. Now, I have a whole bunch of stuff here that we went through in Orlando in great detail, so let me delete some of this stuff that is not topical right now. What I'd like to show you, though, is how we've broken below that 200-day moving average. That's very simple math, but I'll go into much more detail. But typically speaking, when you break below the 200-day moving average and you're coming from above, obviously, one will tend to see some sort of a moving back, retesting, checking back to that moving average. So if that were to occur, it would not really be that crazy to think that we see a rally anything from 3 to maybe even 4 to 5% in the S&P 500. Now, of course, this is a very simple way of looking at things, but I will also tell you, and again, if you can see the screen, you'll be able to see this. If not, don't worry, I'm describing it. We are using a process that I developed while I was working at JP Morgan that has a lot to do with finding extreme overbought and oversold conditions in really anything that we can get our hands on, whether that's equities, ETFs, commodities, interest rates for sure. And what we are seeing is a lot of severely oversold conditions. Now, this does not mean that these names, these stocks, these whatevers have to immediately rally. It's just getting to a point now where it's getting extreme in terms of this momentum to last to the downside. So there may be a pause in order of a couple of weeks or so. Now, I will say this, but I'll also preface this by saying that typically markets don't crash when they're overbought. Markets tend to crash when they're oversold. So it is also thus not impossible to think that markets from these levels right now can crash. I don't necessarily think they crash from here unless, again, we get headline out of who knows where and what. That's always possible, and it's a higher likelihood this will happen here at this juncture. But I'll also tell you that we still have to respect seasonality. So long story short, my analysis, our work is increasingly pointing to near-term, very near-term, potentially oversold readings here. Again, we have the Fed, we have jobs report on Friday, all this week. But we are starting to see things oversold. So, for example, I'll read you some names. Chevron is starting to get very, very oversold. Does not mean the stock has to rally. It just means that it may not continue to go down at the rate at which it has. That's enough. That would be enough for the stock market to catch a breather. Something totally unrelated. Ford, very oversold. And again, if you can see the chart, you can see the vertical X Pro indicators printing there. Anyway, I'm just showing a chart with which shows that it might be oversold. Again, another stock that's totally unrelated, Hasbro. That's got nothing to do with neither cars nor oil. Very oversold. We can go on and on. You look Western Union, for example. That too has very little to nothing to do with the other thing. And last time this stock got this oversold that it is right now was back in March, and then the stock went on to rally all in about 34%. So Bristol Myers Squibb, another stock, totally different, totally unrelated, totally different industry. So for whatever we've looked at, different industries, all sorts of stocks that are getting very oversold. Does not mean they can't ultimately continue to go lower, but it does look like they might be done. So at least for the time being. So I would say these are a couple of the surprises that I'm also looking at for the remainder of the year. So we've got 2 months left, more or less, here for the rest of the year. And I do think there's 3 potential surprises that investors could be in for here for the remainder of the year. One of those surprises is potentially that even though equities may bounce a little bit here, that they ultimately don't really have a Santa Claus rally. In fact, again, the odds are that I should say this. The odds are higher this year that we don't get a Santa Claus rally, and thus that we may even crash. That's not my base case. So please don't say search said we're going to crash. That's not what I mean. I'm just saying the odds are higher than usual that it may happen, that it can happen. That's all I'm saying. So that's one thing that I think might surprise people, is that we don't get a classical year-end rally, because also, quite frankly, if it doesn't start happening really more or less right now, the odds are very slim to none that it ultimately does happen. We need to get something together. We might bounce. I think that is much more likely. We bounce here on the S&P, in S&P terms, 2, 3, 4, maybe 5%, and then we'll have to reevaluate. But that is very near term. I think through the 2-month lens, maybe that would be one surprise, that equities might give it a try, but then actually fail to fall through. That's one thing. The other thing that I think might be a surprise to investors is that we may get some sort of a bear market rally in bonds. Bonds, of course, had an ugly year. I'm just displaying for those people that care the TLT ETF on the screen right now. And I think the overhead supply, or just generally supply of bonds being issued, is going to be managed a little bit better going forward. I would suspect by the Fed, by the Treasury Department. And that might be enough for bonds to start catching a bit, particularly if the global geopolitical situation gets any worse. Then I don't even know if it really can get much worse, but let's assume something happens there that would lead some sort of flight to quality. So that might be a second surprise that could be in store. I'm going to still call this a bear market rally. Again, we talk a lot about this land over the past couple of days, really through all different scenarios, different kinds of portfolios, structures that we might be able to use in this kind of a scenario. So I would not be surprised if the bond market has a pretty big, juicy rally into year end. Maybe the TLT ETF gets back to where it was like a month ago, which is nothing. That would be about 10% higher from here. That's going to feel like one hell of a rally, and it will be one hell of a rally, but it's still within the context of a bear market rally for the time being. So that's one thing that we're watching as well, and I think that's a surprise that we should not totally discount. Again, it certainly looks possible here at this juncture. The third surprise, and I will preface this by saying as well, I'm not a Bitcoin expert, but there is a hell of a lot of noise around this ETF that might get approved, whether it's this year or next year. Of course, I do not know. No one really knows for sure. And then next year we have the halving of Bitcoin, which once again would be a positive tailwind, or just a tailwind for Bitcoin. So that will be a third sort of, I don't want to call that a surprise, because it looks more and more likely, but something that could really move markets, that Bitcoin just gets a big boost. Now, I'll also say this, as I'm recording this here today, Sunday evening on the 29th of October, Bitcoin has now, over the past month and a half, already just rallied about 30%. So it's making a big move in anticipation of all this. It could probably rally even more if this gets, approved. But I would also not be surprised that after a sort of excitement rally, the initial reaction, then once that's done, is maybe Bitcoin sells off a little bit. So I'm just saying this because I just don't want anyone to think that I think Bitcoin is going to go straight to 100,000 from here. I do think ultimately there's going to be, like, some of the math I heard is, once the Bitcoin gets the ETF, if and when the ETF gets approved, it'll be something like $100 million worth of demand for Bitcoin through the ETF alone every single day. That's a lot of demand. Again, some numbers I heard, I can't really quantify that myself. That's a lot of demand for Bitcoin, and that could literally change the structure of it. So that would be a third surprise. But I think all in all, getting back to the topic of what really this quick podcast update is supposed to be about today, I do think we're getting oversold in equities. There might be a bounce in order. And again, a lot of data this week. Personally, I wouldn't want to press shorts here. My personal book, I actually closed a lot of shorts late last week. Part of that also because, of course, I had to run the summit for our clients, but also, again, really because I think we're getting oversold. Now, again, I will say this and preface this. Again, keep in mind, in this juncture of the economic cycle, there is an increasing likelihood that markets have some sort of a crash or a mini crash, and that typically will happen from oversold levels, not from overbought levels. Just to be clear, but again, it's not my base case that markets here crash. I think that's always a difficult base case to have. I would be cautious here, but again, three things that I think could be potential surprise for the remainder of the year. And we only have 2 months left. And if you think about it, we'll have Thanksgiving in between them, at least here in the United States. Of course, we do. Then we move on to December, where there's a lot of year-end celebrations from Christmas to New Year's and Hanukkah and all those kinds of things. So that'll distract a little bit from the markets as well. So I hope this is helpful, folks. Thank you for listening to this week's Steady Wealth podcast, and spread the word. I ask people to go to steadywealthpodcast.com. It's completely free to receive these weekly episodes where I try to give you as much value as possible. And we'll start having a whole bunch of guests here coming up real soon in our weekly episodes. Thanks for listening, and we'll see you again in the next Steady Wealth podcast.